Hello and welcome to today's video, where we're diving deep into a topic that has every cryptocurrency investor on edge, Bitcoin's price plunge and the looming 3.2 trillion crash that's sending shockwaves through the entire crypto market. But what does this mean for your investment, and is there any way to protect yourself from this potential disaster? We're about to break it all down, so stay tuned. Before we get started, let's take a moment to look at Bitcoin's incredible journey. From being worth just a few cents to reaching over 60,000 per coin in 2021, Bitcoin has always been a roller coaster ride for investors. It's the leader of the cryptocurrency world, but like any volatile asset, it comes with risks. Let's explore what's behind the latest plunge in price and what could trigger the next big crash. To understand what's happening right now, we first need to understand Bitcoin's price dynamics. Bitcoin doesn't just rise and fall based on its own supply and demand, it's also influenced by major global economic factors. But right now, we're seeing more volatility than ever before. Let's start by taking a deeper look at Bitcoin and its historical price behavior. When Bitcoin was first introduced by the mysterious Satoshi Nakamoto in 2009, it was worth practically nothing. But by 2017, it had surged to nearly 20,000. Since then, Bitcoin has experienced several massive bull runs, but also severe crashes, each contributing to the narrative of the cryptocurrency's extreme volatility. So what drives Bitcoin's price? There are a number of factors that influence Bitcoin's price: market demand, investor sentiment, and broader economic events. Each time Bitcoin reaches new heights, we see more media coverage, attracting new investors. However, that hype is often followed by sharp corrections, sometimes triggered by major market events, regulatory announcements, or even changes in global financial conditions. Bitcoin's journey to becoming a mainstream asset has been anything but smooth. The first major spike in Bitcoin's price happened in late 2013, when it briefly surpassed 1,000 per coin. Then came the crash. But fast forward to 2017, and Bitcoin hit its highest point yet at almost 20,000. However, that rally was short-lived, followed by a dramatic crash in 2018. Prices dipped to around 3,000 per coin. This repeated cycle of boom and bust has become somewhat of a pattern in the crypto world. But what's behind these wild swings in Bitcoin's price? Let's break down the key factors that contribute to Bitcoin's price movement. First, there's demand. As more people buy Bitcoin, its price rises. When demand drops, its value falls. But Bitcoin isn't just driven by retail investors. Over the past few years, we've seen institutional investors like Tesla, Square, and MicroStrategy adding Bitcoin to their balance sheets. This institutional interest has brought credibility to Bitcoin as a store of value and as a hedge against inflation. On the flip side, regulations can have a huge impact on the price. When governments introduce new policies, like China's crackdown on Bitcoin mining or the US considering stricter crypto regulations, it can cause a dip in prices, as we saw in 2021. Furthermore, there's supply and demand. Bitcoin is capped at 21 million coins, meaning that as more people buy and hold Bitcoin, the supply becomes more scarce, which can drive the price up. Now that we understand the dynamics behind Bitcoin's price movements, let's look at the looming 3.2 trillion crypto crash. The crypto market is already worth around 2 trillion, but a crash could erase a significant portion of that value. So how could a 3.2 trillion crash happen, and why is everyone talking about it now? The 3.2 trillion figure comes from an analysis of the entire cryptocurrency market, not just Bitcoin. With Bitcoin's market cap representing a huge portion of this total, a major price correction could lead to significant losses in other coins, too. We've already seen major fluctuations, with Bitcoin recently dipping below 30,000 from its all-time high of over 60,000. If Bitcoin falls further, it could trigger a wave of panic selling across the entire market, leading to an even bigger crash. So, why is the market so vulnerable right now? Well, there are several factors in play. First, we have global economic uncertainty. With inflation rates rising and central banks raising interest rates, investors are starting to pull back from high-risk assets like Bitcoin. Moreover, there's the regulatory threat. Many countries are tightening their grip on cryptocurrencies, and the US government is considering stricter regulations. This uncertainty is causing a lot of people to question Bitcoin's future. Additionally, interest rates are rising, which means that investors are less likely to put their money into speculative assets like Bitcoin, especially when safer investments like bonds are offering better returns. Lastly, Bitcoin's correlation with traditional financial markets is also a concern. In times of stock market volatility, Bitcoin has shown tendencies to follow the trends, which can be both a blessing and a curse. Now, let's turn to an important question: is your Bitcoin investment safe? When Bitcoin starts to plummet, it can be easy to panic and start selling off. But before you make any rash decisions, let's analyze whether Bitcoin is really a safe investment in the first place, especially during market corrections. Bitcoin has often been referred to as digital gold. Like gold, Bitcoin is seen by many as a store of value, especially in times of economic uncertainty. However, unlike gold, Bitcoin is highly volatile. Its price swings can be extreme, making it less predictable than traditional assets. So, while Bitcoin can serve as a hedge against inflation, it's important to understand the risk involved. Investing in Bitcoin doesn't mean putting all your eggs in one basket. It's crucial to manage risk by diversifying your portfolio. Instead of holding only Bitcoin, consider diversifying into other cryptocurrencies like Ethereum or stablecoins, or even into traditional investments like stocks or bonds. Diversification helps spread out risk and minimize the impact of market crashes.